Welcome to the case study, Balancing Returns and Responsibilities at Raya Partners. In this session, we explore how the private equity firm Raya Partners navigates a critical decision, whether to relocate manufacturing operations while balancing financial returns, employee welfare, and environmental impact. Raya Partners faces a challenging decision. Should ASCC's manufacturing operations be moved from Vermont to Mexico? This could significantly improve profitability, but would also have profound effects on employees and the local community. At the same time, modernized facilities may bring environmental benefits. Above all, this decision puts Raya's environmental, social, and governance, or ESG, commitments to the test. This decision affects multiple stakeholders. Adrian, the Chief Investment Officer, leads the evaluation process. Vermont employees and their families face potential layoffs, impacting the broader Vermont community. Investors expect strong financial returns while upholding ESG principles. Meanwhile, Mexican operations stand to benefit from new job opportunities and investments. Three key issues must be weighed. Financial profitability. Relocating to Mexico promises cost savings and improved margins. Social responsibility. Hundreds of Vermont employees could lose their jobs with ripple effects on the local economy. And environmental sustainability. New facilities in Mexico may align better with climate commitments and regulatory standards. A SWOT analysis highlights the complexities of this decision. Strengths include potential for increased profitability, reduced emissions, and better ESG alignment. Weaknesses involve the negative impact on Vermont employees, community disruption, and reputational risks. Opportunities exist in achieving operational efficiencies, sustainable leadership, and competitive positioning. However, threats include investor skepticism, community backlash, and potential long-term damage to Raya's brand. Several business concepts are central to this case. Corporate social responsibility, ensuring financial success while considering societal and environmental impacts. Communication strategy, managing stakeholder expectations through transparency. Outsourcing and offshoring, analyzing both financial benefits and socioeconomic consequences. And ESG integration, embedding sustainability and ethical considerations into business decisions. One option is to fully relocate ASCC's operations to Mexico. This move maximizes financial returns by achieving cost efficiencies. However, it would result in large-scale layoffs in Vermont. To mitigate this, Raya could offer robust severance packages and establish a community investment fund to support economic recovery. A more balanced approach is partial relocation. This strategy involves moving labor-intensive manufacturing processes to Mexico while retaining specialized operations and research and development in Vermont. To support employees, retraining programs could help transition workers into new roles, achieving moderate cost savings while preserving some local jobs. The third alternative is to keep operations in Vermont and invest in modernization. Upgrading equipment and processes could improve efficiency while maintaining jobs. Additionally, investing in green technologies could reduce emissions, aligning with sustainability goals. This approach prioritizes social impact but offers lower financial returns. Each alternative carries different financial, social, and environmental implications. Complete relocation offers the highest financial benefit but has severe social drawbacks. Partial relocation achieves a moderate balance between cost savings and community impact. Vermont enhancement supports employees and the local economy but provides the lowest financial gain. Regardless of the decision, effective communication is critical. Raya must ensure transparency in announcing its decision, provide direct consultations with affected employees, host community forums to address concerns, brief investors on the strategic rationale, and engage the media to shape a fair and accurate narrative. Supporting displaced employees is essential. A holistic approach includes comprehensive retraining programs to help workers transition, job placement services in partnership with local employers, and generous financial compensation through severance packages. To offset economic disruption, Raya could establish a $5 million community fund. This initiative would support local business development, job creation, and economic recovery programs in Vermont, demonstrating corporate responsibility. Several key lessons emerge from this case. First, balancing financial returns with social and environmental impact is a complex but necessary challenge. Transparent communication builds trust, even during difficult transitions. Engaging stakeholders in the decision-making process can lead to better outcomes. And finally, taking a long-term perspective ensures sustainable business success. Considering all factors, a partial relocation is recommended. This option balances financial benefits with reduced community impact. A $3 million severance fund should be provided to support affected employees, while a $5 million community investment fund aids local economic development. Throughout the process, 100% transparency in communication must be maintained. Thank you for joining this case study analysis of Raya Partners. Thoughtful decision-making can pave the way for both financial success and responsible business practices.